Okay, so welcome to Chapter 1, Introduction to Managerial Accounting. And in this particular chapter, we're going to talk about some of the differences with managerial accounting and financial accounting. We'll also talk about the role of what the managerial accountant basically does in business. And we're also going to talk about some other things, including things such as ethics and also some regulatory issues relating to Sarbanes-Oxley. Okay, so our first objective is we're going to talk about what they call the three primary responsibilities of managers in business, and that's going to be on the next slide. And again, you're going to find that, of course, in this class, there's a lot of information that's going to be used to make decisions. But the three primary responsibilities, they've grouped them into three categories, are number one, planning, number two, directing, and then number three, controlling. And then hopefully at this point, once you kind of get all these put together at some point in time, everything here is going to lead to the decision-making process, which that's what we're going to be talking about how to do that in each of the chapters. So again, the three responsibilities again are planning, directing, and controlling. And so regarding the first responsibility of planning, the basic idea there is you set goals and objectives and trying to figure out how to, ways and how to achieve them. Okay, some examples could be, generate more sales via opening new stores, reduce labor cost. Budgeting, guys, budgeting is going to be a big idea in terms of planning, and there's a couple chapters later on where we specifically work with how to create your master budget and your flexible budgets. Your directing type of responsibility, again, this is going to be for the entry-level accountant. This is going to be more for your manager, is to help oversee the day-to-day operations. These are things typically that are done by your financial controllers. So you're doing a lot more analytical type of skills rather than the number crunching. Okay, so but the idea here is to direct or to help lead the day-to-day operations. Again, some examples down here is you can read these, but obviously using the sales reports, you can adjust strategies. You'll notice that this is at a higher level of function, and again, this is not something that you would necessarily do right out of college. You'd probably need to get 5, 6, 7 years experience working in a company before you're in this type of role. And then finally, the third one, which is controlling, like we said earlier. And again, you got to make adjustments as needed. Sometimes you may have to change your budget. Budgets are always changing. You always come up with a master budget, and then of course you're looking at actual results. But the controlling aspect of it, that's at one of the higher levels in a company. And some examples down here, you're comparing budgets with actuals. You may need to take corrective actions, and you're evaluating employees. Are they able to make the budget, make the numbers and so forth. I remember when I was in industry, that was always the idea was are you making the numbers, and employees are evaluated based on did they achieve results. So again, this is higher level thinking. It's looking at budgets, looking at actuals, and of course taking corrective actions and improvements to help the company grow. Okay, the next main objective we're going to talk about is distinguishing financial accounting from managerial accounting. So the prereq to get into this class obviously was financial accounting. And in the next couple slides, we'll walk you through the differences and how there are some similarities, but there's also going to be some differences and how we approach this class, and also in terms of how we work out some of the problems and how the financial statements are also going to be a little bit different. Okay, so as you look at this slide, this is a very good slide, and it lists, of course, managerial accounting on the left side, and you've got financial accounting on the right side. And if you look at the difference, starting with, for example, who are the primary users of information. So one of the first things you need to note is that for this particular course, for managerial accounting, our primary focus is internal. How does that compare with financial accounting? Oh, financial accounting was primarily for the external user, like the creditor or the investor. And that's actually a big deal because it changes the scope of the rules that you have to follow, and we'll get to that in a moment. But because it's all internal, there's a lot of reports that are going to be prepared that are only seen within the company to make your planning decisions. Because financial accounting is external, all the reports go to the public, you have to follow a certain set of rules that are governed by the regulatory agencies, like the SEC. All right, so that's one big deal. Again, if you look at the purpose of the information, again, notice with financial accounting is you're trying to help the external user make investing in credit decisions about your particular company? Are they willing to invest in your company? And like I mentioned earlier, our purpose here is to plan, direct, and control operations to basically run the business. All right. Now, if you look at the third part here, it says what is the primary accounting product? Obviously, your basic financial statements, income statement, equity, balance sheet, and cash flows from financial accounting. Well, we'll do some of that in managerial accounting, but basically we'll also create some reports. It's really whatever management's looking for. What do they need? So they might want a specific report that's not even an income statement, but that's doing some sort of cost benefit analysis, for example. And that would be an internal accounting report. So again, that's a big difference. You don't have a set, this is how many reports are there. Whereas in financial, it's basically you got your big three or big four financial statements. All right. In terms and kind of piggybacking off that idea, in terms of what you have to include, and this is a big thing, in financial accounting, remember, it's all about the GAAP. It's all about generally accepted accounting principles. Therefore, you got to follow the regulatory rules. In managerial accounting, I'm going to write this over here, non-GAAP. It's non-GAAP. So therefore, we are not regulated. Our reports, because they're generated internally, do not have to follow GAAP rules because we're going to be using these to make decisions. You'll find that later on there is some overlap. Some of the reports may follow GAAP, some may not, but that is not the focus. So again, non-GAAP for managerial accounting, GAAP is the focus for financial accounting. And then finally, this is also a pretty big deal, the basis of information. Think of it like this. Financial accounting is tended looking at historical data. So it's almost like you're looking backwards. In this class, I'm going to just kind of keep it simple. For managerial accounting, it's a future emphasis. We're looking to the future. So you always rely on historic data to make decisions about the future, but specifically financial accounting is all about organizing what happened yesterday and then showing the investors to make decisions about the future, obviously. But our key focus here is strictly the future. We will use some of the historical financial statements to create budgets and to make future decisions. But again, the primary basis in this class, again, is future emphasis. Financial accounting is historical emphasis. Okay, a couple more things to talk about. Again, looking at the comparisons. And of course, look at, this is a big one. This may show up usually on test and quiz and homework types of problems. Is our primary focus in this class, because it's all internal, is we want to know, is something going to be relevant? Okay. Whereas financial accounting always looked at the reliability and being objective. Think about it. You have to follow the GAAP rules, consistent rules to make the financial statements comparable and reliable. And you have to have that audit, the independent auditor, to come in and say, hey, look, these financial statements are following the rules. We don't necessarily have that in this class. So relevancy is the big theme versus financial accounting was more about reliability and objectivity. All right. Now, keeping it going. So it says, what business unit is the report about? And again, typically in financial accounting, you're reporting on either the company. If you have line item segments, there's the 10% rule. Some of you, if you're going to take intermediate accounting, you find out that there's a test you can figure out if you have segments that have separate reports. But basically, you're reporting on the company as a whole. And again, our focus here is we're looking at our products, because we're going to do some chapters on looking at the product cost, or we're going to be focusing on the customer, budgets against sales, how to grow the company. So our business unit is somewhat different, whereas financial accounting looks at the company as a whole. We tend to divide up the business in terms of products and customers and sales regions and so forth. All right. Another big thing is how often are the reports prepared. Remember, the SEC requires publicly traded companies to prepare financial statements at specific time periods, annually and quarterly. You'll notice in terms of this class, managerial accounting is basically whenever you need them. All right. So it depends on the report, depends on the management's needs. So basically, you basically prepare the reports as needed. So that's a difference. And then finally, the verification process. I said this earlier. Basically, the CPA has to come in and audit. The independent auditor has to come in and audit the financial statements. In this case, you don't have to have an auditor to come in financials. So no audit necessary, because these again are all internal reports. Nobody actually sees them except the management. And just to kind of wrap up some of the differences between managerial and financial accounting. And again, this is kind of goes with what I had said earlier, but remember, because you don't have independent auditors coming in and looking at your financial statements. And again, notice for managerial accounting, no authoritative body requires these reports. So there's basically no SEC involvement, whereas financial accounting is governed basically by the SEC. All right. And then finally, the last thing is there a concern over how the reports will affect employee behavior? And I think that's relevant for both, because with financial accounting, obviously, you're concerned, are you misstating the numbers? Are the financial statements reasonable? Because that could affect decision making to the public. So the idea there is to protect the public's interest. And of course, the same thing with, internally, if you make bad decisions, you could have impacts on employees. Companies could go under. You could have bad morale if you're not following the budget and the standards correctly. So again, there's a little bit of overlap. Most of these are similar on the last one. So, employee behavior could be affected. That's not really a difference. That's more of a similarity. And I've already kind of mentioned the big differences. And just to kind of summarize, managerial accounting is internal, it's non-GAAP, it's future emphasis. Financial accounting was external, it was GAAP, and it was basically had to be audited, by the SEC. Okay, so in the next objective, we'll talk about the organizational structure and the roles and skills required. And it should also note that you get hired into a company, you need to know where you fit in within the organization. That's going to also help define what you do within that company. And here you can look at a basic organizational chart. Notice at the top, again, this is looking at a publicly traded type of company. Notice you've got the board of directors that are at the top. They tend to appoint what they call executives. And you've got the CEO, that's an appointment, that's an officer of the company. You also have, beyond that, you've got chief operating officers, chief financial officers. And again, think of these as just titles. Some companies actually combine duties. So just using this as just an example. Below an operating officer, you could have vice presidents. If you're under the financial area, you're going to have the treasurers, the controllers, and of course you also have an internal audit typically. Sarbanes-Oxley requires most companies to have internal audit, and within that there's also going to be an audit committee that's going to then report back to the board of directors to make sure that everything's running smoothly. So again, this is basically trying to give you an idea. You get hired into a company as an accountant management. Where would you typically fit in? Well, if you look at the objectives and the primary responsibilities in this particular course, you're going to basically be under most likely this area, whether you're dealing with the financial officers, controllers, and so forth. You'll be in management, but remember, the type of jobs to get to these levels, you're not going to get these right out of school. You tend to have 5 to 10 years experience before you get either elected or appointed to these type of jobs. Okay, now regarding roles of management accountants, obviously, if you think about it, technology has really changed the way that we conduct business. So obviously, depending on where you're at, you're going to be able to use a lot of technology to quickly make decisions. It definitely helps out in terms of your financial records. It used to be back in the 90s, for example, at one of the companies I worked for, we always had to wait like a couple days before we could actually look at the financial statements. Whereas now, with the way technology is, you could almost, once you record something in a journal and post it to a ledger, you could basically almost instantly get your financial statements and so forth. So obviously, the role of management accountants, it's probably less to the number crunching and more analytical. There's more critical thinking skills. So this idea of the role of planning, analyzing, and interpreting accounting data, I would always say, the critical thinking skills is really what companies are looking for. It's not just can you get an A in a course, it's, can you think outside the box? So like I said before, analytical skills, the concept of memorizing, it used to be back in my day, they wanted you to memorize everything. And then it got to the point where everybody could memorize, but they couldn't think. So some of the things you definitely need to know and be able to do eventually in accounting, obviously you have to have the analytical ability. You should all have at least taken an Excel course or have some familiarity with Excel. That's probably one thing I always tell my in-class students is to make sure you take an Excel class, use Excel. All employers use it typically. It's good for spreadsheet building and creating models. teamwork, being able to work on teams, your communication skills. Sometimes people don't realize that even in accounting, you have to be able to write. You have to have good English skills. And I've even known, for example, on a couple companies where people basically got let go of their jobs. They were in an audit role where part of the role was to write financial reports. Their writing skills was judged to be inferior, and they actually lost their jobs because they couldn't write. So definitely think about some of these skills that are required of accountants. It's not just the old are you good in math idea. It's a lot more than just math skills. Okay, and to wrap it up, the last few slides we'll talk about is the Institute of Management Accountants, known as the IMA, and we'll also talk a little bit about ethics and how ethics is used in the profession of accounting. So like I said earlier, for management accountants, just like you have a CPA, with management accountants, their equivalent of a CPA, they call it a CMA. And the IMA is basically, that's the professional association, that's the group that leads the management accountants. They do a lot of work, again, very similar to the CPA, but again, the focus is managerial accounting. In fact, the CMA exam, some people would say matches or is as tough as the CPA exam. There's a lot more decision making, a lot more critical thinking tools that are used in that test. Although, the CPA is still a tough test, but the CMA, typically, if you ever see that behind somebody's name, you know that that's basically their main idea, their main focus of career paths would be in management accounting. But the IMA also works with the research and education and development. They write the CMA exam. They also work a big part of the ethics, which we're going to talk about in a moment. So in terms of ethics, they came up with their professional code of ethics, and the IMA came up with the following. They have what they call competence, which is to be professional. Confidentiality, which if you think about what that is, not disclosing, confidential information. You have integrity and credibility. So they got this split among 4 ideas, and obviously to comply with their code of ethics, you have to comply with all these different standards to be in their ethical category. Now, in terms of what does ethics mean, what are we talking about? And it's not always just legal versus illegal things. But it's basically sometimes just doing the right thing regardless of the consequences. And you can think of so many ideas of so many problems that happen within companies, but people, filling out fake expense reports, not going somewhere but still getting reimbursed for it, manipulating the numbers. Okay, sometimes companies can try to do that to make their income look better or worse, depending on if they not want to pay taxes. Performing tasks not qualified to perform. Lots of times you don't have competent people doing the job. So we'll get into, if something is unethical, could it also be legal? Or what's the legal or illegal ramification? So you're going to find out that some behavior, even though if it's unethical, it might be legal, it's just unethical. And so typically, if you can find some sort of behavior that's not appropriate, usually a company will have a set of steps that you follow. And for example, you follow their policies. Typically, if you go work for a company, you should have access to their policy for how to deal with unethical behavior, and it could be sexual harassment or whatever. And so you would want to follow the company's policies first. And usually, if you can't resolve it by the policies, you typically want to discuss with your supervisor. If the problem is your supervisor, maybe you want to talk with another supervisor. And believe it or not, in some cases, if it's something that is pretty much illegal even going on, you might even want to talk to an attorney to look at the consequences. A lot of this could deal with whistleblowing. You could see, like one of the companies I worked at, they had a price fixing scandal going on. And you might want to get with an attorney to see what are your rights. Are you also going to be in trouble if you blow the whistle on the company? All right. So again, there's some steps that you can follow to help resolve the ethical dilemmas. So again, like I mentioned earlier, not all unethical behavior is actually considered illegal, but all illegal behavior is definitely unethical if you think about that term. Unethical behavior could be, again, being dishonest, unfair. Again, fairness is something that even if something's not fair doesn't mean it's illegal. Lacking objectivity, irresponsible, and so forth. The dishonesty, depending on what you're doing. If you're talking about something that is fraud related, for example, that definitely could also be illegal as well. So the last thing I'm going to mention is to talk about some of the regulatory rules and laws that came up and how that's also impacting business and management decisions. And one of the big ones, if you have not heard of it just yet, is called the Sarbanes-Oxley Act of 2002, and the acronym for that is SOX. We'll talk about that in a moment. I'm going to also briefly mention the thing about the International Financial Reporting Standards, also known as IFRS. Of course, in the US we have GAAP. Internationally they call it IFRS. So basically the Sarbanes-Oxley Act arose because of specifically the problem with Enron, and you can just do a Google if you wanted to search Enron and the problems they had back in 2001 and 2002. And basically what happened was is you had corrupt independent auditors, you had corrupt management, the financial statements were grossly in error, you had auditors who were basically lying about the fairness of the financial statements, and as a result the company basically went bankrupt. All their investors, the employees, all lost all of their jobs, and it's because of this. And basically some of the top people, the CEO, the CFO, they actually sold all their stock before all the stuff went down. So they called it golden parachutes, where basically they got rich and everybody else got really, really poor. And so because of that, Congress came up with the Sarbanes-Oxley Act to try to ensure that, they call these white collar crimes, that basically it holds the financial management accountable for everything that they present to the public. So, for example, any financial statement that's presented to the public, the CEO and CFO have to sign off on it. So even if anything arises, that even if they did not know about it, they are still accountable and they could go to jail if there's a problem. So they used to call it the I don't know defense doesn't work anymore. So because a big part of the problem was is a lot of these people went to court and they testified in front of Congress with the Enron scandal, and the executives kept on saying that their excuse was is they did not know, and that just drove Congress really, really nutty. So they kind of came up with this part of the Sarbanes-Oxley was is the I don't know defense is no longer good. So in other words, even if you do not know, they're holding you accountable that you should have known. And so there's a lot more accountability with the financial statements, and it doesn't mean that stuff still doesn't happen. There's still fraud and false disclosures, but it has eliminated a lot of the problems that happened back in '02. Now, the thing about the IFRS, I'm just going to mention briefly, is that, globalization, think of all the companies that do business overseas. And so lots of times you have to be consistent with the reporting standards worldwide, and that's what the IFRS. There was a project going on with the FASB. Remember, FASB is the group that writes GAAP, and they were trying to converge and compare all the GAAP standards. They were comparing GAAP with IFRS, and they were trying to merge them together. And they're still looking at this, but I think they've kind of determined that it's very difficult to completely change everything just to say we've got one set of rules. But if you ever come across IFRS, that's the international rules. But remember that our stuff still here in the US is still US GAAP based.